Welcome back to The Explainer. If you've been watching the screens lately, you know things have gotten, well, a little chaotic. Today, we're taking a step back. We're going to calmly and objectively break down that sudden, jarring drop we just saw in the semiconductor index. We need to look past the sea of red on your screen and figure out what this actually means for the broader AI narrative. Because believe me, it's not time to panic. It's time to understand the logic behind the numbers.
Right. So overnight, the market got hit with a shock. We saw absolute industry giants, Micron, Nvidia, TSMC, suddenly facing this intense downward pressure. And naturally, the immediate anxious reaction from everyone is to ask the million-dollar question. Did AI hardware just peak? Is this massive trend officially over? When leading indicators start flashing red, human nature basically pushes us straight toward panic. But our job today is to tune out that emotional noise and look at the actual market mechanics.
To do exactly that, we've got a very clear roadmap for today. First up, the AI market shakeup. Then we'll look at why hardware is under pressure, followed by the software shift. After that, we'll cover key market indicators and wrap up with how to stay calm and rational. Let's dive in. Okay, Section 1, the AI market shakeup, moving beyond the panic of the overnight drop. So what exactly happened? We saw a clear, really unmistakable pullback across the entire board. The semiconductor index, the SOX, took a significant hit. Then you've got Micron, ticker MU, and the broader storage chain facing really heavy selling pressure. And we aren't just talking about the memory guys here, the absolute top-tier AI hardware giants, the darlings of the market like Nvidia, AMD, and TSMC, they all slid at the exact same time. Now, when you see a coordinated drop like this across foundational infrastructure players, that is not a coincidence. It is a structural shift in market sentiment. Moving to Section 2, hardware under pressure. A stress test, not a death sentence. Our core theme for today's analysis is pretty simple. AI hardware is under pressure. What does that actually translate to in the real world? Well, it means the early-stage, super crowded AI hardware trades are currently facing a much-needed stress test. The AI hardware narrative? It is absolutely still the main thread of the market, but those specific sectors that just got way too crowded, way too fast, they're being forced to prove their sky-high valuations right now. So let's unpack this stress test. What does it actually look like? The fundamental value of these tech giants didn't just vanish overnight. Instead, the market is basically hitting the pause button to digest incredibly high expectations, especially after the latest earnings reports. Investors are staring hard at high bandwidth memory, DRAM, server memory, literally the vital organs of AI infrastructure. And they're asking one very critical question. Can the massive capital expenditures from major cloud providers actually sustain this booming pace indefinitely? See, when expectations are priced to absolute perfection, even the slightest hint of hesitation in cloud spending makes the market aggressively take profits off the table.
All right, Section 3, the software shift, following the capital rotation.
This brings us to the core divergence in the AI trend right now. It's fascinating. Capital is visibly rotating away from AI hardware, which, like we said, is now stuck trying to validate sustained demand and testing the absolute limits of corporate capex. And where's it going? It's moving directly toward AI software. Why the shift? Because the market is suddenly demanding hard proof. It wants actual return on investment. It wants to see real orders, efficiency gains, and solid profit margins from concrete enterprise applications. If hardware represents the promise of AI, software has to be the actual delivery of its economic value. Now, a quick reality check. We have to stay totally objective here. You cannot just blindly jump from one hype train to the next. A true, sustained rally in the software sector requires actual enterprise orders and real revenue growth. The sector cannot survive purely on speculative money that's just briefly fleeing hardware to hide somewhere else. Software companies absolutely must prove they can lower costs and boost efficiency for their clients to justify this new influx of capital. No real orders, no real rally. Section 4. Key market indicators. What to watch in the A-share market. To navigate this kind of volatility, you need a highly specific roadmap. So keep a close watch on these 3 critical indicators to gauge the market's true health. Number 1, watch for resilience in semiconductor equipment and advanced packaging. Are they holding their ground against external macro-level panic? Number 2, look for real technical support levels for storage, testing, and materials once that initial wave of panic selling finally washes out. And number 3, keep an eye out for a sustainable recovery in AI apps and data services. And by sustainable, I mean we aren't looking for those brief, wild spikes right at the opening bell. We want to see steady, continuous strength all throughout the trading day.
So, how do we turn that into a practical playbook? When evaluating those indicators, strictly follow this 3-step checklist. Step 1. Check if the broader sector actually has structural support or if it's just falling straight through the floor. Step 2. Observe if the undisputed leading companies in that sector are the ones driving the momentum. Leaders lead, right? If the leaders are lagging, the rally is probably fake. Step 3. Confirm if the trading volume actually matches the price action. An upward price movement with practically zero volume? That's a trap. You want heavy volume confirming the market's conviction.
Finally, Section 5. Staying calm and rational. The playbook for retail investors. Listen, if you take absolutely nothing else away from today's explainer, please let it be this. Maintain a calm approach and strictly avoid making impulsive trades during the chaotic, emotional swings of the opening bell. Seriously. The first hour of trading is so often driven by overnight panic and massive institutional repositioning. The absolute worst thing you can do is try to outguess the algorithmic chaos right at the open. Just sit on your hands, let the dust settle, look at the indicators we just talked about, and trade the reality of the day, not the fear of the morning.
So, wrapping up our analysis today, no, the overarching AI trend is absolutely not ended. But the easy money? Yeah, that's probably been made. As capital rotates and demands harder, mathematical proof of value from both the hardware and the software sides, I want to leave you with a crucial question to ponder as you review your own portfolio. Is the market actually done expanding, or is it just getting a whole lot pickier? Thanks so much for joining me for this explainer. Stay calm, stay structured, and I'll catch you next time.